let's start with the weekly quote here. The weekly quote is from my boss, Susan Chen. She's the senior managing director for the public equity team here. And this quote is directly from the podcast they interviewed her from, Coffee with Capital Allocators, the podcast. It's directly from 100 Women in Finance. It's going to be posted there, but I decided to at least share a quote, right? I don't think it's invading anything. So if hard things were easy, the world would be a really boring place. I like this quote, simple, sweet, and like it's exciting to be challenged, right? Like do the hard things because that's what makes it fun, right? Nobody likes doing anything super easy and having it repeated every day. And that's that. Now for outperforming moments. We need 3 today. Yes, Joe.
I'm going to Chicago in December for the AGU conference, which is the American Geophysical Union. It's about 25,000 attendees or so.
Nice. That's a good thing. Another outperforming moment. Anyone else? I see so many hands. Come on.
Yeah, one moment. You got an outperforming moment?
I have an outperforming. I mean, yeah, I have an interview tomorrow with TRS. It's not an official interview, but it's like, you know, the hello thing. It's an interview. Another outperforming moment. I know Alex has one. He's like hiding it. What's your outperforming moment, Alex? Happy birthday, Alex. All right, everybody cheer for him. Another year. Congrats on that. You're gonna sing happy birthday, Andrew? All right, that's for later. That's for later. All right, let's skip through it now and let's continue with the market outlook by Juan Carlos Gallegos. Let's go.
Hello, everyone. So with the agenda, first we're going to talk about the markets. Then we're going to dive into net interest income. Then bank earnings, then capital requirements for banks, Goldman Sachs, Tesla revenue breakdown, and Elon. So first of all, markets have been really choppy, as we all know, for the past few weeks. There's a bunch of reasons that sometimes markets go up and down. This the CPI report came in at 8.2%, lower than the August 8.3%. It's still really high, but people are just trying to see any slight of good news to get it back into the markets. So the markets rebounded a bit. Obviously, the last 2 days it's gone down again, but interestingly enough, whenever the report came in, the markets went like dive deep. So I mean, they went super red, and by 11 a.m. they all rebounded and were green again. But whenever the CPI report was announced, the Nasdaq had dropped 3%, the S&P 2%, and Dow 2%. And then some people are saying that the CPI, the inflation rate, has peaked because we've had a few low numbers in the 8%. So that's why some people are saying we should go back in and buy. But one of the worst news was the fact that the core CPI increased by 0.3%, which is not good. But people are just, that's why the markets are really crazy. It's hard sometimes to even describe what's happening. So according to Wall Street Journal, Akani Otani, one of the reasons there was a reversal is when things seem too negative, fund managers buy, causing a reversal. Other people were saying that managers covered their short positions. And others think inflation has peaked, and others believe stocks are at a deep discount and start buying back. Now, this is a quote by Dan Genter, Chief Investment Officer at Genter Capital Management. The fact that you're seeing some peaking out in inflation to where maybe we just don't have to fight the Fed so much, people will feel comfortable buying at these levels. Let's talk about bank earnings. So one of the reasons why banks on Friday and the past 2 days, almost all commercial banks reported earnings. And one of the things that helped banks report good earnings was net interest income. Whenever interest rates rise, net interest income for banks rises as well. It's kind of the same thing with oil companies. Whenever the oil prices went up, some of the oil drillers like Chevron and Exxon made more money. It's the same thing with banks. Whenever interest rates rise, they make more money. What's one of the reasons is, so there's two things. There's interest-bearing assets and interest-bearing liabilities. Some of the interest-bearing assets are basically mortgages, car loans, etc. And some of the interest-bearing liabilities are CDs and savings accounts. And they can manipulate those two things in order to get a better margin. So this is one of the examples. So let's say the bank has 1 billion loan portfolio with 5% interest and a 1.2 billion in interest-bearing savings account, which is the liabilities. And whenever they increase interest rates, they can increase their assets to a 7% interest, and they can increase their liabilities by only 2.2% because that's their ability to do that. And they increase their income by almost 100%. And even then, JP Morgan had the highest ever recorded net interest income in history. So that's another thing why net interest income is helping commercial banks beat revenues. So like I said, Bank of America beat both earnings and revenue. JP Morgan beat both earnings and revenue. Wells Fargo the same story, and Citigroup the same story, which is interesting because obviously investment banks like Goldman Sachs and Morgan Stanley, while they both beat their earnings per share and revenue estimates, both of their estimates were lowered from last year. And while all the commercial banks actually, while they lost in net income, they had bigger revenues than last year, which is something the investment banks didn't do, all because of net interest income. So now let's talk about capital requirements. Like I said, banks' net income are going down, and one of the biggest reasons is investment banking, and also one of the biggest reason is investment banking, and also the fact that they have capital requirements. Now, what's capital requirements? So after the financial crisis, the Dodd-Frank Act came in, and basically it makes banks have some sort of capital set aside in order if they have bad loans or something happens, so they can release those reserves. And this is an interesting story. In 2021, Q3 2021, during the recession in 2020, they had to build their credit reserves. And in 2021, whenever everybody thought the pandemic was over, well, it was kind of over, and everything was flourishing, they were allowed to release the reserves, which increased their net income. And now that there's a looming recession in the next few months, banks were asked again to increase capital requirements, which means they obviously have to set aside revenues and net income as a part of their. So basically, they can't loan out this money, and whenever they release it, they can loan out the money and make money from it. Right now, they can't. So this is affecting their net incomes, and that's one of the things the CEOs of American banks say it's kind of not fair because they can't make enough money, but they're also kind of protecting us of a next financial crisis. And one of the things the CEO say is that in China, since the government helps a lot their Chinese banks, they're allowed to be more over leveraged because they know China is going to kind of help them if things go bad. So now let's talk about Goldman Sachs. Obviously, they both they beat earnings and revenue estimates, but like I said, their targets were lower than last year's. They announced their third major restructuring in 4 years, which is not ideal. They're basically kind of changing their pre-established plans because it's not working. And now they're changing their lines of business into 3 major groups: global banking and markets, which is going to have investment banking and trading under them, and asset and wealth management group, which is going to be obviously those 2, and then platform solutions, which is going to cover all the consumer banking. Whenever the new CEO came in, he wanted to go into consumer banking in order to kind of change from the high risk, high reward business they have in terms of investment banking. He wants to have more predictable earnings. So that's why they changed into consumer banking. And also sadly for some of the people that work at Goldman Sachs, not sadly, maybe they were just not performing as well. They did the restructuring and they changed a lot of the managing directors around the company. Like I said, CEO wants to diversify from high risk, high reward to a business that's steady fees, no matter the environment. This is a Goldman Sachs CEO who's a part-time DJ too. He said, operate more efficiently as we drive higher, more durable returns. And last year, they acquired a European asset manager called NNIP in the attempt of obviously trying to replicate BlackRock's assets under management fees so they can have more predictable earnings. Now let's talk about Tesla. Tesla reported earnings today, and they beat analyst expectations on earnings per share, but they missed on revenue. Apparently, they had some issues delivering some vehicles. So that's the reason they didn't beat on revenue. They doubled profits from last quarter, from last year's Q3, from 1.62 billion to 3.33 billion. Automotive revenues were up 55% from 12 billion to 18.7 billion. And this Elon Musk outlook on the next quarters for Tesla. So he's saying, I can't emphasize enough, we have excellent demand for Q4 and we expect to sell every car that we make for as far into the future as we can see. And then he said the factories are running at full speed and we're delivering every car we make and keeping operating margins strong. So that's important because in the summer, whenever China went back into lockdown, the Shanghai factory wasn't working at full capacity. So now obviously everyone working at full capacity means more and better earnings for Tesla. So like I did with Google, I wanted to kind of show the revenue breakdown for Tesla. So 87% of their earnings come from the sale of cars, obviously 18 billion. Energy generation and storage, so that they also sell energy and they also sell energy and they have I think it's like a battery they put in houses. So they make 5% of that. And services, so servicing cars and probably some green credits, that's also part of the services, another 7.66%. Lastly, let's finish with Elon on Twitter deal. He was asked today in the press conference. So a lot of people were wondering why nobody asked Elon Musk about Twitter in his previous press conferences in the Tesla earnings. So somebody asked him and he said, I'm excited about the Twitter situation. I think it's an asset that has sort of languished for a long time, but has incredible potential. And then he ended by saying the long-term potential for Twitter is an order of magnitude greater than its current value. So obviously he can probably turn around the business and obviously having the name of Elon Musk behind it is going to push the stock. And that's it. Now with the economic perspective, Alex.
All righty, let's go. Economic perspective. We got over a bit of the international CPI report, and then the apartment demand falls, and go over some retail sales, right? Report that came out. All right, so what is the IMF? So the International Monetary Fund is an intergovernmental organization, right? So they aim, their mission is to reduce global poverty, encourage international trade, and promote financial stability. So they were established in 1944, part of the Bretton Woods Agreement. So they have 190 members, right? So there's 195 countries, and 190 of them are members in the IMF, right? So they have to, their functions are to oversee the economies of those member countries and lend to those countries with balance of payment issues, right? They also lend for other issues as well, like if they need help in financial crisis and stuff like that, which they are doing right now, right? So they help member countries modernize their economies. So they have this, like, as you see at the bottom of the picture, 303 million have allocated for technical advice, training, and learning, right? So they can keep up with their monetary policy and kind of help their economies out. So the IMF is funded through quota contributions. So each country donates or gives them a specific percentage based on their GDP, right? Or like the size of their economy. So they will give them a percentage of that and called quotas, right? And that's used for their funding, right? So they have 1 trillion amount available for lending total. So right now they currently have 34 lending arrangements and 76 recipient countries of emergency pandemic financing that they've given to. Like right now, disbursements this year, they have 106.5 billion disbursements this year, which is actually the record they've loaned out in a single year. 2020 was the closest, but 2022 has topped it. We're not even done yet, so I wonder how high that's going to go. They still have a remaining funds of 700 billion, and these are some of the countries they lent money to: Pakistan, Sri Lanka, Zambia. I'm not sure if I'm saying that right. Egypt, and then Chile. So yeah, what these kind of countries have in common is that they're all mainly import countries. So they import a lot of oil and gas, as well as some like commodities. And so those are kind of, because of inflation, they've increased, the prices of those have increased and their currencies have decreased. So it's costing more for them to purchase these goods, right? So they're having a lot of inflationary issues in that sense. So September CPI, we have the CPI month to month. It came in at 0.4% versus 0.3% expected. The core CPI came in month to month at 0.6% versus 0.4% expected. So that just kind of shows that month over month, the core CPI that excludes gas and food, so the volatile sections of the CPI report, is increasing, at a higher rate than CPI. So, in August or September, the gas prices were still kind of down. So that kind of, is a reason why CPI is lower than the core CPI or is increasing at a lower rate than the CPI. But it might be differently October, since right now the gas prices are kind of moving back up because of OPEC decision to cut 2 million barrels a day. Right. So again, CPI year over year, 8.2% versus 8.1% expected. Core CPI year over year, 6.6% versus 6.5% expected. So surprisingly, like Juan Carlos said, at around 11 a.m., the market just U-turned and it finished it gained 4.5% that day, right? Kind of crazy. A lot of people were saying, like Carlos said, that people were covering their short positions, kind of just getting out of them. So you can see here in the top or the picture that the highest for the month over month change was the piped utility gas services, right? That 2.9% change month over month. And then next is the motor vehicle maintenance and repair at 1.9%. The loser, the biggest loser for the month over month was the gasoline at negative 4.9%. I wonder how that's going to look next month. Right? It might be a little bit different. So the falling gas prices helped keep inflation lower, like I said. And also another thing is the rents have risen 7.2%. That's the biggest gain since 1982. Right? Medical care costs are also up 6%, which is the largest increase since 1993. So we have for you real estate guys, we have apartment demand falling. So this Real Page Analytics firm, they're a data analytics firm, mainly just covering multifamily properties. So it's all they look at. And so they reported that we had the weakest third quarter for apartment leasing. In the 30 plus years they've been tracking the US market. All right, so kind of a big deal. Although September, it said, is usually the softest month. It's the only third quarter we've had leasing down, right? The first negative quarter, I mean. So the report indicates that rent collections are at 95.6%. So it's kind of pretty high. I think it's higher than the previous month, they said. So rent collections is not a problem. Also, there is no flight to affordability. So all three assets saw a decrease in occupancy rates. So that means no one's kind of moving from higher rents to lower rents. They all kind of saw decrease in demand, right? And the incomes have jumped 11.6% of leasers. So it's not an income problem either. And apartment vacancies were up 1%, right? So kind of just going with the occupancy rates that decreased. And so they're saying that consumers are right now in a wait and see mode with inflation just kind of going crazy. They're not too sure, what's going to be the next, what's going to be in the next couple of months, how the demand or how the apartment prices are going to move. They're going to keep going up or kind of down. So they're kind of just in a wait and see mode, right? So retail sales came in at 0.0% versus 3% expected. So they came in flat, right? As you can see in the picture, their nominal total was at 0%, but since inflation came in at 0.4% month over month, their real total was negative 0.4%, right? So we saw a decrease in real retail sales. There's a 0.1% of auto dealers are excluded, but it increased 0.1% if you take out the auto dealers. Then you had the drivers, so the auto and parts and sales dropped 0.4%. Receipts at gas stations declined 1.4%. And bars and restaurant sales rose 0.5%. So people are kind of, still drinking, still eating out. Kind of a good sign, I guess. So retail sales are important because they kind of show, how the consumers are feeling, how they're acting. Right? They're spending a lot on retail, right, centers and services. Then the economy is deemed to be healthy, right? If the retail sales drops, that means consumers are not as lenient on their spend, or they are lenient on their spending. They're kind of scared or kind of waiting on the economy, right? So the economy might not be doing great during that time if the retail sales are going down. All right, so for me today, guys, you guys want to connect with me on LinkedIn? You guys can go ahead and do that. Yeah, we don't have a mergers and acquisitions today, but
anyone on Zoom next year? I get mine on Zoom. Is it there? Yeah. You see it? All right. All right. Some of y'all heard this story before, but I remember hearing the biography of Chuck Yeager when he passed away some time ago. He's famous as a test pilot. And I thought it was interesting. The Economist had a biography of him, or big obituary for him, saying what made him unique was he was both a test pilot and a mechanic, which gave him a huge advantage over other test pilots, because when something happened with the plane, he knew what was going on. He could hear it, he knew how to fix it. And what does that have to do with finance? Well, I started off as an accounting major. And an accounting major, I had to know accounting. Then I switched to finance. Now I have to know accounting. Oh, I got to know finance. Oh, I got to know economics. Oh, I got to know marketing. I got to know actuarial science. I got to be Chuck Yeager, but with 20 more hats. And it's amazing me, and being in finance, I was expected to know everything because you're making huge decisions. I know people who go into finance because accounting was tough. That's like the worst possible reason to go into finance. I don't know how to do an analogy of that, but yeah, it's that finance has to know accounting better than the accountants do. They better know economics. It's interesting. I spoke at Bond's company by Zoom, and their CEO, I used to work with her at UTSA. She introduced me as UTSA's chief economist, which is kind of crazy. I think I told you that before. But I had to know economics, even though I don't have that many hours of economics. You have to know marketing. You have to know operations. One thing Dr. Miser here, when he was here, great professor, one complaint he had about finances, we have this view that the world just works magically. Customers show up, workers show up. There's never any problems. We don't have a view of how firms actually operate. And in reality, every firm, HEB right now, there's some major crisis going on at HEB at some store. Someone is just flipping out. Something broke, someone didn't show up. But we in finance, the numbers show up and it's all perfect. Accounting is probably just as bad. So the reason I say all of that is I got this article. I love Lacey Hunt, y'all know. And here's his latest quarterly outlook. Lacey Hunt is an economist, and I love reading Lacey Hunt. Alex is doing a great job with economic information. And why do we have a chief economist for the investment society? You need to know economics. So if you can get a master's degree, you could get an MS in finance, that would be fine. But you might get applied economics as well. That might be to diversify yourself a little bit outside of finance. But I love Lacey Hunt. Are any of y'all reading his stuff? From Hoisington, he's up in Austin. Incredible guy, really smart guy. Well, he's talking about Paul Volcker. Why would you talk about Paul Volcker right now? That doesn't make sense. Paul Volcker, that was the early 80s. Why would we care about Paul Volcker? What did Paul Volcker have to do?
Volcker shock, he combated runaway inflation.
Yeah, right. He had to fight high inflation from the 70s, which is where I grew up. I remember when gas prices hit $2, we were all freaking out. What are we going to do? We'll never drive again the rest of our lives. We can't believe gas prices are so high. It's crazy. So Paul Volcker comes in. So Lacey Hunt's talking about Paul Volcker asking, does Jeremy, oh, I forgot our Fed chairman's name. Jeremy Powell, excuse me. Does Jeremy Powell get it? Jerome Powell. You'll see when you become a professor at 60, you'll forget your own brother's name. But Jerome Powell, does he get it? He says there's two things Volcker learned. Jerome Powell learned one of them. He hasn't learned the second one of them. So it's an interesting article. What I thought, first of all, the thing I saw was that Volcker wrote a biography, and I didn't even know that. Did y'all know that? That he has a book out? Anyone read that book? So now I got the next book. I've got like 8 credits on my Audible, and I can't figure out what to read. The last book I read was wonderful. I really loved it, but I need to find a new one. So this might be my next book. The autobiography, Keep It at It, The Quest for Sound Money and Good Government. It was published in 2018. And I think he passed away right after that. Right? When did he pass away? Someone Google that. I think it was just right after that, like 2019. So the Fed understood, he's talking about Volcker, the critical role of money in causing inflation, and that the Fed could not back away from restraining money growth without risking a damaging loss of credibility that once lost would be hard to restore. Now you say, well, Volcker came in, he had it all figured out, but if you read his quotes from the book, he was actually not quite sure. He said, I did not realize, or did I realize at the time how high interest rates might go before we could claim success? No. From today's vantage point, was there a better path? Not to my knowledge, not then nor now. He didn't realize he's going to push interest rates up to 15, 16, 17%. But he did. Volcker and Friedman, y'all know Friedman, Uncle Friedman, Milton Friedman. You should read all of his books. He's a really good writer. Milton Friedman, his big thing was money supply. We're aware that velocity of money is not stable. Now, let's see how many of y'all know this formula. This is my favorite formula in economics. So anybody remember it from last night? Colin, you were there. You remember it?
P minus
P
plus Q.
times
Oh,
Q equals what? It's right there.
oh, the money, the velocity.
M times V. I love this formula. I use it all the time. So what is the P? Price, inflation. What's the Q?
Demand.
Output. What's the M? Money supply. What's the V? Velocity. Y'all see this formula a lot in economics, don't you? And then don't forget it, right? Remember, you can be Chuck Yeager. I love this equation. So we haven't had inflation the last several years, but the money supply shot up dramatically. Why didn't we have inflation the last few years, but the money supply is so high? That's velocity. Velocity just knows that. Obvious reasons, pandemic, people weren't out buying groceries or weren't out buying restaurants and those kind of things. What happened this year? Velocity picked up, people started spending those stimulus checks. We had supply chain problems, so output was coming down. If velocity is going up and output's coming down, not much room for anything else to go. Price has got to go up. What he said Friedman was surprised about was how unstable velocity was. He said Friedman, and I don't know enough about Friedman. His monetary theories are over my head. But I saw Friedman once before he passed away. He was at an inflation conference. Very intimidating guy, but really nice guy, but just intimidating because he's somewhat, he's kind of floats around. Very, very, I love listening to him read his books. He's a very respectful the way he writes. But he was somewhat surprised just how much velocity could go up and down. So it makes it a little difficult to manage this process. But he says the equation that GDP equals money times velocity, the best approach for the Fed to achieve prior stability was to rely on this basic monetary model. I mean, this is it. They've got to handle, so the money supply is coming down because the Fed's shrinking its balance sheet. Velocity is still pretty high. So what does he say? Powell, like Volcker, has clearly demonstrated that an economy cannot inflate away its problems. So he's saying Powell gets it. We can't have inflation. So he got one of the two. What didn't he get? Without price, well, before I get to the what he didn't get, what price stability, without that, we will not achieve a sustained period of strong labor market conditions that benefit all. The burdens of high inflation fall heaviest on those least able to bear it. You're certainly seeing that. Alex talked about rent. You talk about people who are struggling with income and then suddenly their rents go up a bunch, food prices go up a bunch, gas prices are up. They're like, give us a break. What do you expect from us? We can't handle it. It's pretty amazing. But what about the money supply? Powell, in testimony before the Senate, disagreed very sharply with Volcker on the role of money in the same hearing in which he incorrectly said that inflation was not a problem anytime soon. He had an interchange with Kennedy on money and inflation. In response to Kennedy's concern that rapid growth in money would lead to accelerated inflation, Powell replied, when you and I studied economics a million years ago, M2 and money aggregation seemed to have a relationship with economic growth. Right now, M2 does not really have an important implications. So something we have to unlearn, I guess, but he probably shouldn't have unlearned that. But anyway, 180 million Americans suffer the largest permanent decline in real wage, salary, and retirement income since 1980. The size of this pain was far greater than the benefit. So yeah, we got extra job growth, but he's saying it wasn't worth it for what these people are going through right now. This major difference is very significant since the Fed has constitutional responsibility for the supply of money with effective but not total control. Money is the closest variable in their arsenal to affect economic change. By ignoring money growth, as in recent years, the Fed is less likely to know when it is consistent with price stability. So what are the Fed? He's essentially saying the Fed let money supply go and velocity came down to protect them. And they said, see, the equations changed. They just assumed velocity would never come back. And now they're paying it. They went too far. Without accounting for velocity, Friedman's optimum quantity money is based upon the economy's production. Currently, in that formulation, money growth should be constrained to the range of 3 to 5%. Velocity captures all of the following factors. You can read through that. Banking economy with shadow banking, wealth, financial innovation, most importantly, the productivity of debt and the shifting composition of bank assets between investment and government securities and loans. So there's a lot of things going on to affect these. If y'all want this article, I'll send it out to y'all. Or just go to their website. It's Hoisington, Hoisington management. And he puts that out there for free. You can just go and get it. I really recommend. I love his writing. What he does, which I think is really important, I think Alex is doing a really good job on this, is you can't just know the headline numbers. You got to delve in much deeper to the numbers. So you say inflation's up. Well, inflation's up. Which inflation is up? Because some inflation, when it's up, it actually reduces output, which actually reduces inflation. So gas price is a good example. When gas prices is up, people cut back on other things. They buy less, more expensive things, which actually depresses the economy. So there are some things that prices go up, they actually are deflationary themselves. Understanding those interactions, and that's what he's saying. His final conclusion is a little depressing. See if I can get to the end of this. You saw that right there, recession on the horizon. You've been hearing that. The stock market hasn't been saying that, but y'all know who MBER is? It's another great site. Go to their site. Wonderful site. They're the ones that call recessions. They have tremendous amount of historical information, really interesting charts. They have 7 indicators. And there's the 7 indicators. This suggests the drop in GDP the first half of 2022 was not a fluke. So are we in a recession or not? We had 2 quarters of negative GDP growth. That doesn't mean we're a recession by MBER. They have other measures. They're more sophisticated, but he's saying it wasn't a fluke. The economy really did slow down. The most notable exception to the recessionary tendency are the 2 employment measures. So employment's still strong. You saw that. And really strong. In fact, the last employment report, the stock market really hated it and sold off because it was strong. But both are lagging rather than coincident indicators. They're not telling you where the economy is going. They're not telling you where the economy is. What do they tell you? They tell you where the economy has been. Also, with jobs rising and demand falling, productivity is slumping at a record pace. This is a sign of job hoarding, an effect that will sharply erode profits if continued. Essentially, firms are keeping workers that they don't really want to keep, hoping things turn around. It's killing margins. They're going to eventually have to let these people go. Conclusion, the Fed greatly damaged their credibility when they allowed inflation to race far above their target. Sadly, deteriorating economic prospects are a direct consequence of the Fed's failure to execute their responsibility. Almost universally, the other members of the Fed have supported the Fed chair's position that low inflation is of paramount importance to deliver a rising standard of living. If the Fed were to abandon its commitment to inflation target, the FOMC would suffer a major double blow to its integrity, which would be increasingly more difficult to restore. As Volcker so cogently argued, failure of the Fed to achieve its target will also have the consequence of allowing an emergent money price wage spiral to become entrenched, causing a dismal replay of the 60s and the 70s. The Fed's mettle will be tested because highly over-levered institutions will fail as they historically have done. So the Fed has no choice. They've got to kill inflation, and they don't care who else gets killed in the process. And someone will get killed in the process. Does that sound optimistic for you people about the interview for jobs next year? You just hope JP Morgan keeps hoarding jobs, right? Final conclusion, treasuries will increasingly reflect a looming recession and its deflationary circumstances. He says interest rates will be lower next year, possibly. Good writing though, isn't it? And he has some of the best charts, not in this one necessarily, but he has charts where he shows stuff. You go, wow, I can't believe those are numbers. So he says, here's what the headline number says. Let me tell you what's really going on. It's powerful stuff. I'll stop it there. I don't want to bore you with economics, though. I don't think it's possible to get bored with economics. All right. Wait, what's the equation again? I think I heard it. Heard a lot of P's and Q's. Okay, so P times Q's equals M times V. I think it's the greatest equation in economics. So anyway, all right, that's it for me. If you want the article, email me and I'll send it out there, or maybe you can put it on there. Did you find it? It's pretty easy to find. PDF. All right, thanks.
Everybody signed in? Can I go ahead and roll for the gift cards? Thumbs up, thumbs down. All right, I got your thumbs up. That's good enough. All right, while I run this, let's have our social chair real quick. We have the sweet spot. Oops. Come up here real quick to talk about an event, upcoming social event.
Can I get a quick raise of hands? Who likes board games? Anybody like board games? That's good to hear. I'm glad you guys had a good childhood. So this Saturday, we are actually going to be joining in with OSA at noon. I believe we're going to have it at UTSA here on campus. That way, easy access, even though it's a Saturday. And, STEM versus business. Let's hope we win on whatever games, whether it be Uno. I'm not sure we'll have Cards Against Humanity, Monopoly, probably Connect 4. I'm not sure what type of games we'll have, but I think we all have sequence as well. So I hope you guys like that. And any other future events, I'll keep you guys posted. For this, I'll put it on the Discord and the Telegram, specifically what room it'll be, or if we'll have it in the library. Market Watch competition. Let's see. We have Raul Medina in first place. Is he here by any chance? Give him a good congratulations, guys. And Jacob Bell, second place. Is he here by any chance? And Jackson, third place. Awesome. All right. Awesome. Congratulations. I hope you all stay in the top 3 spot. I hope, I'll probably make it to the leaderboards. I'll see myself up there. And again, polos, $25 in the meeting. And if you're $20 for members.
All right, thank you, Juan. While I rolled the raffle winners here. We are selling polos. Is anybody interested in buying it right now? Raise your hand. So we could put them away like pretty soon. All right, that's good. That's good. For the exciting part here, can I get a drum roll for our first winner for tonight? Jonathan. Blockham. I hope I said that wrong. Right? I mean, is Jonathan here? Present in person? Okay, nice. Congrats for winning the first. And then winner number 2. Give another. Devin Driscoll. Congrats. Okay, are both winners there? Perfect. Y'all can come up here at the end of the meeting just to get y'all's email address. But thank you once again for another successful meeting here. Pretty short relative to the other ones. Hope to see y'all next week and stay connected with us. That's our link tree. We have all our socials there. And I did put the document Professor Sweet was going over today on our socials. So feel free to look at that. Thank you for today. All right, y'all, we need to go. Have a great night. Thanks.